I have some good news. Lots of people talk about how active fund managers in the equity space struggle to beat the index. But in the world of corporate bond funds, it's a completely different story. Look at this. Almost every single fund in this category is outperforming the primary benchmark. In fact, over the last 3 years, every single corporate bond fund, all 20 of them, has outperformed the corporate bond index. Active fund management isn't just surviving in the fixed income world, it's thriving. So, if broadly all funds are winning, how do you pick the best performers? In this video, we're doing a deep dive into the best performing corporate bond funds across the 3, 5, and 10-year timeframes. We'll break down exactly what's working, who's leading the pack, and reveal the most important takeaway of all, when scheme selection matters and when it doesn't. Nothing in this video is investment advice, nor a recommendation to or not to buy, sell, or hold any security. Please do your own due diligence and consult a registered financial advisor before dealing in any security. Let's set the stage. This is a massive space. We're looking at 21 active corporate bond funds managing over 2 lakh crore of investor money. In this video, we're focusing on the 20 funds with at least a 3-year track record. The giants in this category are HDFC, ICICI, Aditya Birla, and SBI, together controlling a whopping 60% of the category's assets. Do the biggest players deliver the best performance? Let's find out as we roll through the timeframes. Over the last 3 years, the benchmark returned 7.14%. The average fund, however, clocked nearly 8%, a fantastic result. But here's where it gets interesting. The performance gap is significant. Our top 3 performers, Nippon India, Axis, and Franklin India, averaged a stellar 8.41%. The bottom 3, Bandhan, Sundaram, and Canara Robeco, were closer to 7.6%. That 81 basis point average difference between the best and the worst performers is a huge margin in the low volatility world of fixed income. This proves that even when everyone is beating the benchmark, fund selection matters, particularly in the shorter term. And investors are taking notice. The top 10 performers in this period manage on average 14,500 crores. The bottom 10, 5,800 crores on average. Performance is clearly driving AUM migration. One quick but critical note, while Franklin India is a top 3 performer by absolute return, its rolling returns over the same period slide all the way down to 9th place. A great reminder that how you measure returns can drastically alter the leaderboard. In fixed income, the first rule of investing is capital preservation. So let's talk about risk. We're going to pay attention to a critical but often overlooked metric, maximum drawdown. The largest peak to trough decline. The average 3-year maximum drawdown for the 20 funds in this category is 3.44%. This is our baseline for what's considered normal risk in this space. On the stability front, funds like the DSP Corporate Bond Fund and ICICI Prudential Corporate Bond Fund score well. They clock in with the lowest volatility figures at around 0.76 and 0.86 respectively. But we have an outlier on the drawdown front, which we'll address in the unique schemes section later in the video. Now we expand our view to 5 years. The universe shrinks slightly to 18 funds, but it still represents over 98% of the AUM in the category. What's the first thing you notice? Returns have declined meaningfully. The benchmark return is down to 5.92%, and the average fund return is 6.48%. The cohort's outperformance over the benchmark has also shrunk from 89 basis points to 56 basis points. And here we find our first underperformer. The DSP Corporate Bond Fund returned just 5.77%, making it the only fund to clock a sub 6% return over this period. But who's leading the charge again? The podium remains virtually unchanged. Nippon India is the only fund to cross the 7% hurdle, with Axis and the rest close behind. The biggest climber over the 5-year period versus the 3-year period is the ICICI Corporate Bond Fund. By showing the smallest decline in returns compared to its 3-year performance, it climbed from 9th spot all the way to 4th. Consistency is its superpower. The longest time frame brings us the highest returns, with the benchmark at 7.19% over 10 years. We're looking at the 12 funds that were active over this decade. The average fund returned 7.53%, only 34 basis points ahead of the benchmark. This is an important pattern. The longer the time horizon, the harder it is to beat the index, and the gap between funds reduces as well. Over this decade, 2 funds underperformed the benchmark: Canara Robeco and the Baroda BNP Fund. Who were the long-term champions? Franklin India, HDFC, and ABSL, all delivering returns around 7.85%. Now let's talk about what this means for your money. A 1 lakh investment would have grown to 2,13,000 in the best performing fund, but 2,01,000 in the lowest returning outperformer. That's only about a 6% difference in absolute end amounts over a decade. Even comparing the best fund to the absolute worst performer, the Baroda BNP Fund, the difference is about 14% absolute over 10 years. Compared to the median return of 7.65%, the absolute difference is 4% over the 10 years. This is the biggest takeaway of the video. While fund selection in the short term, particularly in equities, can lead to massive differences, in the corporate bond space over the long term, the impact of fund selection is relatively muted. Before we wrap up, I have to talk about some individual schemes. First, the reigning champions Nippon India and Axis. Earning the first and second spots over both the 3 and 5-year timeframes is a spectacular achievement. The consistency is admirable. The Baroda BNP Fund is the most fascinating case study in this category. It's the champion of cost efficiency, with a category-leading return to TER ratio of 41.45, driven by its ultra-low expense ratio. But, and this is a material but, the Baroda BNP Paribas Fund has the highest maximum drawdown in the entire category, a staggering 10.84%. Additionally, while this fund has underperformed over 10 years, it has acquitted itself well over the shorter 3-year time frame and is the 4th best performing fund in the category over that time period. The Franklin India Corporate Debt Fund has been quietly outstanding, particularly over the 10-year time frame. In fact, if we average out the performance across all 3 time frames, an admittedly unseemly procedure, Franklin and Nippon India are tied at the very top. Don't let its short-term volatility fool you. Its long-term track record is stellar. What we've seen in the corporate bond fund category is a convergence of performance over time. While some funds have superior track records, the core lesson is this. The most important question for you is not which fund is the best, but does the corporate bond fund category deserve an allocation in my portfolio at all? That's where you'll see the biggest impact on your overall wealth. So I want to hear from you. Which corporate bond funds are in your portfolio, and which do you think will be the best performing funds in this category in coming years? If you found this data breakdown useful, don't forget to hit that like button. It really does help us. Also, subscribe for more deep dive financial analysis. Thanks for watching.